Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I'm looking through the comment section. I'm gonna answer some questions or make some comments on subscriber comments. So it says Nordic American tankers was up to 29% last week and Frontline was up 22%. I think it's time for tanking, like the tanker shipping, to enjoy some good times. Dry cargo have been very strong, but now it really looks good for tankers. And that could very well be. I don't really cover that sector too much, but I can. I can do a quick, I guess, charting of a bunch of companies. I don't know those companies inside and out. I know Doug Casey's pretty heavy in the tanking area. I think Trader Ferg is also looking at the tankers, or maybe it was someone else that I was looking at. But I'm pretty heavily in the exploration, oil and natural gas, and the oil companies themselves. If we're at peak oil, I'm just throwing it out there. I don't know if we are. I would think that we would be shipping a lot less oil. Um, and if we're at peak natural gas in some areas, I would think we're shipping a lot less natural gas. But that's just kind of how I think about it. So the most valuable companies in the world would be energy related that are finding new deposits, or however you want to call it, new oil fields in the world. And that's kind of why I went with Recon Africa, is because it's kind of like the last big deposit. There's going to be some few deposits that'll be found that are big. And I would think that those are going to be the most valuable deposits that we find. And I know everyone in the world, they think that we're just going to roll into these renewables and it's going to be very easy and it's going to be a huge S-curve adoption and we're just going to adopt all this stuff. It's going to be amazing. But I don't think we have the minerals to do it. That's my honest opinion. I don't think it's going to strain silver, it's going to strain copper, and we don't have the pipeline to fill these projects at the rate that I think we want. So I think between now and 10 years, I think we're going to see some massive price increases on commodities. Massive. More than what anybody can imagine. And I don't know if we're ready for that. I mean, people don't think about it. They've been in their entire living life, and this includes most baby boomers, their entire adult lives has been living in a 40-year decline of interest rates. They've been living in we'll call it a large expansion of everything at exponential paces. We've been expanding oil supply growth, natural gas supply, absolutely everything at exponential paces. And if you look at kind of where we are in peak production of things, I think we're over the next 10, 15, 20 years, we're going to hit peak production of almost everything. I mean, copper, silver, uh, oil, natural gas, maybe natural gas, we'll see. But there's a lot that I think we're going to peak and kind of come down. And building a world in a mineral intensive, electric vehicles or renewable world where we have to store electricity, which we haven't done before, it's going to be, I think, it's going to cost a lot more, and it's going to be a lot more difficult than what most people think. I I think it'll be easy in the beginning, which kind of where we are now, but it's going to get a lot more difficult at the end, where we're going to start hitting constraints in minerals, or the price of everything's going to rocket higher. It's going to make these things basically unobtainable because the pricing is going to be so expensive. I'm talking about renewables in general. But that's kind of my just overall opinion. It doesn't mean that that's going to necessarily be right, and it doesn't mean that it's going to be that negative. It could be something that's just where it gets more expensive, and the cost of energy just increases in general. So that's why I kind of look at physical metals in your hands as such uh, a good bet, because it's the least risk way to play an energy crisis. And if you've got monetary metals, and I've been coming around on gold quite hard. I'm almost thinking that gold could be another very good asset to hold as one of the top ones, because it's a monetary asset, and this stuff's hard to get out of the ground. It's very hard, and if you have an energy crisis, you're not getting that stuff out of the ground. And energy backs everything. It backs all of the economies. It allows you to have these large economies, and it backs the dollar and bonds. If you don't have a bigger world in the future, to pay back all of these future payments, everything collapses. Now, I know people are going to directly go to, oh, that's deflationary. Well, I don't know, because everything on the opposite side is also going to be going down. Everything of your production, because it's all backed by energy. Energy is the basis of life. It's the basis of everything. And if energy becomes drastically more expensive, and I know everyone thinks that technology is just going to solve everything. And you know what? The downfall of every society in every single, like in everything in history, has been that complex society that depend on technologies have all crashed because they've become so complex. And I don't know if that's going to be the route that we necessarily go. I'm just saying that things are going to get a lot more expensive. We've been in a world of abundancy, that things have continually gotten cheaper. But if that energy price goes up, or if we hit peak oil, if we hit peak anything, I think things are going to get a lot more expensive. And those who are positioned for more expensive, I'd say, energy input costs are going to do very well. So if you're invested in energy, if you are invested in uranium and all these things, and you're buying it at not even decade, this is like century lows, 100 plus year lows, I think it's the biggest opportunity I've ever seen in my life. Because if we are at all right about an energy crisis, I mean, these things are going to rocket higher. They're going to give you so many multiples higher on your investment, that I think that energy is probably, I think, one of the best investments for the next 10 years for easy. Could be for the next 20, 30 years. Could be the rest of your life. And I know when your back's to the wall, humans are pretty smart and they can figure out a lot of solutions. So we'll see what happens. We could see a far different world just in 10 years out. And maybe this sparks a completely different world. This guy responded with CPS. I was talking about baseload energy in the discovery. CPS is counts per second in the number of disintegrations per second, as measured by a radiation detector. Thank you for that unit of measure. It says, if tech lowers prices, why does everything become more expensive year after year? If aging demographics are deflationary, where is the deflation? What happens when populations start to dwindle, when there is less people producing stuff, but the amount of currency stays the same? So the design of the currency has to grow. You need the base money to pay off money, the principal and interest. So you need the principal to expand. And then the interest expands massively. That's a fractional reserve lending system. If the system itself is designed to be expanded, I don't know how you can have a deflation, like a long-term deflation. You can have bouts of deflation where things deleverage, but I don't know where you could have a long-term deflation. But there are prices that go down, like computer prices, prices of TVs, and some other things that do go down in price. But the overall mix of everything, the monetary units, has been inflating. So it's a weird scenario. It says, do you have videos about diamonds? I find Serene Technologies interesting. The only thing I'm worried about diamonds is I know they make synthetic diamonds. So I don't know how that plays in with the diamond mining companies versus synthetic diamonds. I think that's kind of screwed up the whole thing. But it says, Andy, are you buying lumber after the massive pullback? I would buy lumber. I just don't know. I don't know how to necessarily play it. I'm not like in the futures markets or anything. I just buy mainly the companies and ride the companies higher. But yes, lumber I think would be a good one to look at right here, right now. Looking at this, let me go down. So here's a question. If we could see higher interest rates in the future, and as per your thesis, number of houses will go up, those concludes that there would be more houses in the market, won't it? And hence, can't say about the price, but the value of homes could go down further. Well, I think you've got it kind of backwards. The houses come about from higher house prices. So the cost of new homes going up is your floor. And that floor has been going up. So if someone wants to build a 3,000 square foot house in this location, and your number of people for that house is increasing. It's the most it's probably ever been. You're going to get bidding wars for new homes. And if your input costs continue to increase, whether it's energy input costs or lumber or whatever, the price of the house goes up. The cost curve of what it costs to build goes up. So you're not going to get more homes immediately. You're going to build what people want for the price that they're going to offer it to you. And prices will continue to go up of all homes until you hit a market balance at some price. Last expansionary phase, a big expansionary phase in the 70s, there was homes in California that went from $40,000, and this wasn't from the bottom either. This is from kind of like the middle of the move, 40,000 to 440,000. It did a 10x in like 5 years, 4 or 5 years. And that was all during an expansion phase of real estate where they were building more new homes during the baby boomers. And that is the power that I think that we have behind the market, the momentum. I think that the prices are going to go up a lot higher. Interest rates will follow. They don't lead, they follow. So the housing market's going to go higher. It's going to get larger. It's going to expand. It's going to be inflationary because the new loans are coming in against it. And then rates will go up because it puts them in a real negative rate environment. Bonds will say, sell them. I don't want to see it. It's going to put a lot of pressure on. It's going to put a lot of pressure on the Federal Reserve to buy bonds and hold it down, because what it's going to do, it's going to put the government in a situation where they can't pay their interest payments. And I think you're just going to see a massive amount of inflation. They're just going to inflate it away. 98% or so of countries decide to inflate the debt away. They end in massive inflation. And then the inflation will bring the debt levels back down. So we'll see what happens. I'm in the inflation camp. I'm not in the deflation camp. Looking down, I think Caitlyn Jenner is uniquely wrong about commodities. I like that. 11,000 subscribers around the corner. Yep. It says, during the latter part of the RE expansion phase in 2007-8, oil went up to $145 per barrel. After the crash, it dropped down to 35. I've never heard any of the famous analysts state that real estate leads the way of everything else follows. Everything makes so much sense when analyzed from a real estate angle. Yeah, that's what I've looked at in history. And when you look at real estate, and you got to play with this stuff. You just throw stuff in, you look at some charts, you cross them over, you start looking at things. And the more familiar you get with looking at all this stuff, the more confident you'll get in your investments. And then even the technical analysis doesn't matter as much, because it's like you look at the real estate market and you say, okay, where are we at? And you see real estate just plowing higher. I mean, that's what we're doing right now. We are plowing higher. Nothing's stopping this market until you get inventory. And the inventory is going to have to be built by new homes. So you get that new homes being built, it becomes inflationary. Then the next thing you look at is you say, okay, inflation rate's going way up. You start looking at interest rates. And that's why I look at interest rates all the time. I look at the 10-year yield. If the yield's going up, that means that they're worried about inflation, the bond market. Now, we have a really weird dynamic going down right now. We have the dollar. The dollar is going up, the index against other currencies, which means that all currencies are being printed like mad worldwide. The index is going up, but that doesn't mean you're in deflation. It just means that the dollar is less weak than all of the other currencies, because we know we have like a 6% inflation rate. If we have inflation, the index is only indicating relative value or relative performance against falling currencies, which is a weird dynamic, because we know we have inflation and we know we have interest rates that want to go up, and they are going up in the very short term. If we break that big downtrend line on interest rates, because remember, inflation comes from the real estate market. That's what I propose, residential real estate and the loans coming into existence. We need to look at the 10-year yield. If the yield breaks to the upside, we're going to have a big rotation of money. Now they're going to try to hold it down. I guarantee they're going to try to hold this down, and I don't know how this is going to work. They're going to have to buy every single bond that's ever created that, and how much money that's going to be created. So it's going to be a weird scenario. Now I know usually what happens is rates go up, oil goes up, and energy prices go up all at the same time because that inflation comes into the system, and it likes to park itself in oil and uranium and the energy sectors. That's like a really good spot to be, natural gas. So that's one that I think is a good play. And precious metals, they're going to come right behind it. They're just delayed. All the metals are delayed behind it. So what I think is happening is we're seeing these sell-offs in some of these base metals and precious metals. That's just providing an opportunity for people like us who know what we're doing to pick it up. This is like picking $100 bills up. We're just picking it up off the ground saying, okay, I'll take that. I'll take this too. Because when you invest in those companies, they're just sitting there waiting to be taken. And I like the royalty companies because if we're going to create this new world, I think copper's, if energy is the basis of everything. You've heard me say that before. If copper's our gateway to this new energy world, copper is going to be one of the most valuable base metals, in my opinion. So I've been loading into Nova Royalty, and I have no relationship with them, but Franco-Nevada, EMX Royalty, and Nova Royalty, those three royalty companies have a lot of copper in them. And some of these, like Newmont Mining, and I'm not saying to buy Newmont, but Newmont Mining is starting to build more copper deposits. They're going to be mining more copper. So I think that's a good way to play it, is the royalty companies that have a lot of copper exposure. So Andy, gun to your head, in the next few months, which will outperform, uranium or oil? Ooh, you're taking my two favorite sectors. I don't know. That's a good one. Oil has the momentum right now. Uranium does not. So if you were to say on the short term, I would say oil. But you said next few months, which means you've got a few months out. Uranium's pretty volatile, and that thing can roll. So I don't know. I can tell you what I'm doing. I'm buying both. I bought Northern Oil and Gas recently. That's one, and Crescent Point. And I've been buying uranium. I would buy uranium companies too. So I've been buying both. I put my money where my mouth is. Mouth where my money is, money where my mouth. Yeah, one of those. But yeah, natural gas. Remember, natural gas is usually paired with oil. So natural gas has been doing very well too. I would say oil and natural gas are going to outperform uranium in the next few months because we're coming into winter. That's my guess. But uranium is also an incredible pick, and it could outperform it. It's hard for me to know. It says, natural gas price up. China, Germany, and Japan energy shortages up. Nuclear power plants up. Uranium price up. They're all up. Everything's up, guys. We're going to see an energy crisis, and natural gas, oil, all this stuff's going up. Kathy Wood was playing the game on easy mode last year and didn't realize it. Now she's not coming to terms with the fact that she's a mediocre investor. Well, maybe she's good. I don't know. I just think that interest rates is going to be a headwind to it. And we're coming to a point that I don't think a lot of people realize that a commodity boom is coming. And it could be a big super cycle in oil. And I just think people don't think about that. They don't realize that. And I think it's here. And you know how I'm invested. Energy is huge in my portfolio, and so are the metals. Says, I don't think this will impact the long-term bullish outlook for commodity space, but I can't see interest rates rising too high with the amount of debt loads being carried. QE would come back real quick. Also, with the massive increase in RE, real estate, and average mortgage loans being taken, there's probably a ceiling on what can be afforded. The reason why interest rates of 15%, etc. in the 80s could be stomached is because mortgage size compared to median income was much less. That could very well be the case, but another thing to think about is there's a lot of people with a lot of assets, and those assets seek something to go into. If the stock market starts to tank and the bond market starts to tank, and this is where people, I don't think they're realizing this. If the money starts to rotate, because inflation, if it's going to put everything in a real negative rate, it's going to pressure rates to go higher. I mean, it's going to put so much pressure that I don't think people are realizing it. Right now, it's not, but it will. And if that money starts to leave, where is that money going to go? You don't have that many options. It goes to real estate, precious metals, and commodities. And these are all like really, really small in comparison to the bond market, which is huge. So if the bond market goes in a long-term bear market, and rates only have to go up a little bit, it doesn't even have to go up a lot. They're going to be put in a bear market. And that money is going to go somewhere. So you guys are all looking at it from an affordability perspective of people. I'm looking at it like we have 150 trillion going into a market that's only 5 to 10 trillion, which is real estate, and a commodity market that's teeny. Where's all that money going to go? And what's it going to do to that market? So everyone's looking at it like this guy who has a job can't afford it, and that's their income. I'm looking at the big money saying, like BlackRock and these big financial types saying, we need to put trillions somewhere. Where do we put it? Oh, we got the real estate market. They're going to buy all the real estate up. What are they doing? They're buying all the real estate up. And the people who are trying to live in these homes, they're going to be renting them. They're not going to be buying them because these guys who have trillions of dollars has nowhere to put it. They got to go out there and buy it all. So the viewpoint's very different from mine because you guys are looking at it from a affordability perspective of individuals like myself or yourself or whoever. I'm looking at the big money saying, where are they going to put all those tens of trillions in a markets that are all small, far smaller? So I'm positioning myself in the markets that money is going to flow into. So I think that's the big difference of the viewpoints that we have. I mean, that's kind of how it's different. High Andy video is great. They're talking about the update. Is the foreseeable boom in commodity implies that the dollar will be a long-term downtrend? If not, what are the fundamental factors you think underlying the coming commodity boom market? It's the real estate market. The real estate market's going to be inflationary. Now, the dollar is strengthening, but it's against a whole bunch of currencies that are falling worldwide. Historically, the dollar has been weaker than the other currencies during this time frame, but it could be different because it seems like everywhere housing markets are booming everywhere. We're having inflation everywhere. So maybe the dollar will be the strongest of all of the falling currencies, and while the dollar's falling as well, because the index is just an index stating what's the strongest of the fiat currencies. It doesn't mean that you could have an index go up with the dollar going down in its entirety. It's just going down less than all the others. And then I'm starting to come to the realization of that because we're going to have inflation. I just think that the index is saying that it's just less than everything else. She has declaimed deflationary boom because of increased productivity due to better access to high-tech products. Yeah, I know that she's saying that. She said that about everything. And the demographics is larger right now in home buying years in America. I'm looking at the one below it. But yeah, that's you don't get deflationary from high-tech products. Prices can fall, but prices don't determine if you have inflation and deflation on a monetary area. So monetary means that the definition, at least what it was back in the day, is inflation means you expand, deflation means you contract. You can't expand and contract prices. You expand and contract your money supply. That's what the definition was in the beginning. That's the definition that I accept. If you have inflation and it gets bigger, that money goes somewhere. It doesn't just vaporize. So technically, high-tech products can't affect inflation and deflation because by definition, it's just the expansion and contraction of money. The expansion is through the real estate cycle in a expansionary phase where you have new loans against new homes with credit expansion. It's a leveraging up. The deleveraging is the deflationary aspect. And that's probably why she doesn't understand or why she has it wrong, is because that definition, the expansion and contraction, is inflation, deflation. Has nothing to do with prices. The way that they defined it today is prices because they can manipulate prices. The Federal Reserve can. And they can say hedonic adjustments, substitutions. They can do all these things to manipulate prices, but they can't manipulate the overall money supply of expansion contraction. That's why they defined it as such before, and why they defined it later, so they can manipulate it. So that's why they use prices now, so they can manipulate it. But it doesn't fit the definition of inflation and deflation. If I'm right on the inflationary aspect of the expansion phase of real estate, then you're going to have higher interest rates, and higher interest rates are going to rotate money out of the stuff that she owns. And I know everybody thinks that they're going to hold these interest rates down. I just think it's going to be so inflationary that you're probably going to get a rotation of money anyway, because it's going to put everything in a real negative rate, a massive real negative rate, which is going to force everyone to sell their bonds, and then they're going to do QE and buy trillions of dollars of bonds. That's what they're going to have to do for the Federal Reserve. So if you guys like this clip, I'll stop it here. If you guys like this clip, give me a thumbs up. Subscribe to the channel if you like the channel. And thank you for listening. This is Finding Value.